There's one big hidden trading key that the elite traders on our desk have all mastered, but which very few retail traders ever understand or do correctly. In this video, our seasoned trader Garrett Drinan dissects this one big hidden trading key, its step-by-step detail. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to learn.
How many times have you found yourself wishing you'd bet bigger on a trade or regretted putting too much size on in a spot that was really not the moment to do that? Consistency is not just about picking winners or having your executions in the right spot. Consistency is also about knowing exactly how much to bet and when. So today we're going to tackle the concept of dynamic bet sizing. So by the end of this video, you'll be able to apply this concept to your own trading to turn what may often feel like guesswork into a precise science. Dynamic bet sizing is a skill. It's something I've had to work on. There was a time when I would risk way too much on a subpar trade idea and then risk not nearly enough on a big time opportunity. There was way too much linearity between how I traded my B trades and how I traded my A plus trades. And there was not nearly enough spread between those feeler positions and those real see it moments. So it's amazing how many struggling traders reach out to me who actually have edge somewhere in their trading, but are simply not risking their trades properly. So it's tough to get this right if you're relying purely on gut feel, if you don't have a system for not only sizing your trades properly, but also scaling this process consistently to grow your business. So it'll be nearly impossible to get this right. So today I have Jen with me, and Jen is an intern here on the S&B desk in New York City. And Jen has been working hard on her game. So Jen's developed some playbooks, some really solid playbooks. And around these playbook reviews, the subject of sizing has come up a lot. So I want to dive into some of these plays and discuss how we might think about the process of dynamic bet sizing within some real world examples. So we'll start with a Tesla play that Jen traded, right? You actually traded this, right?
Yes.
Okay.
Yes.
Because we don't
I was
always...
a little too small.
You were? Okay.
Yeah.
Okay. Well, good. That's then perfect. Jen, why don't you just kind of take us through the setup and what you were looking at, like before you put on the trade, like why you might even have been watching Tesla on this day.
Okay. So this was, the setup was that Tesla had this breaking news, and it had just broken out of an important like technical level on the daily chart. And there was this change of sentiment that was happening in Tesla. So these delivery numbers, this was like the first beat that we've had in a while. They beat by having exceeded the expectations by delivering 443K units instead of the 439 that they had predicted. Tesla also reported a record deployment of 9.4 gigawatt hours of energy storage products in Q2, surpassing the previous high of 4,000 megawatt hours. And this is by more than double. So that is also very important for the follow through that we might see. Other important variables from this slide are the RVOL, which was 3.6. For a stock that's like a mega cap like Tesla, 3.6 is like very high RVOL.
Right. Yeah. And that's probably one of the key factors for one of these plays, right?
I highlighted it.
You
Yeah.
highlight it,
I don't know why I highlighted ATR. But
So coming into this, expectations were pretty low for Tesla's delivery numbers, right?
Yeah.
Like I think I remember it must have been every day the week leading up to this.
Mm-hmm.
Like someone would come out and lower their estimates on the delivery numbers.
Yeah, I did write that in there that
Okay,
they had
great.
originally were expecting like 450K deliveries, but then they readjusted them lower before the actual numbers.
And somehow Tesla kept trading higher. So like as you said, Tesla was already kind of breaking out on the daily chart, but into this, it hadn't really gotten going, but it was just breaking out.
Yeah.
And expectations were really low. So here's the daily chart, and I mean we had been basing for a long time, right?
Yeah, so we had been basing for like several months. We had that Musk pay package news, but that didn't really break us out above 200. It just kind of broke us out above 180. And then in the days prior to this trade, we were able to break the 200 level, and we got some momentum going already. I remember, I think I traded Tesla like the days prior to this news, and it was unusual because the day before this news came out, Tesla closed up higher, like over 1 ATR. Yeah. And like the several times before this, it always closes down over 1 ATR going into delivery numbers. So kind of we had some like changing sentiment too, because delivery numbers are becoming less and less important in Tesla, is what I've been hearing, and that they're becoming more of like an AI play and like the robotaxi and all that stuff. So yeah, and then one other important thing that I will point out from this slide, Tesla, it's a great momentum stock. It can really get going off the lows. One thing that I heard Steve say was it's actually like the one stock that can go up faster than it goes down. And you can see that here as I show, like there's been historically very large percentage moves. So like you might think like, oh, it looks so extended on the daily chart, but not really, considering what Tesla is capable of.
I see, that's a huge factor for me. I love that you went back and kind of measured other moves that it had made, because it's so easy on a play like this to say, oh, it's just like it's up too much, like we can't buy it today. Yeah. But the fact that it's Tesla and not another stock is huge in that factor. Like we might not make this play with a similar type of catalyst on like a totally different kind of stock, right? Yeah. Like if this was like Ford or something, you know, maybe we wouldn't be thinking the same way, but it's Tesla. We know it can really move. Yeah. All right, so it's gapping up, right? It gapped up in the was it the pre-market?
The pre-market had a great breaking news trade. I believe I traded that trade as well. Yeah, but then this one was like after the open of the next day, I believe. This was the next day after the breaking news came out.
All right, so in the pre-market, so you have this kind of mapped out, right? We're gapping up on a good delivery number that had really low expectations on a chart that's already kind of breaking out, and a name that's been basing and has been known to make huge moves. Yeah. Okay. So at this point in time, you probably have somewhat of an idea of how you're going to grade this trade. Now, you don't have all the information, right? You only have those static things, those things that we know before the market opens. But were you already thinking that this could be, that an A+ trade could present itself here to the long side?
Yeah, because it's had just been so in play for like the last couple days. I saw the RVOL. I mean, that is once it opens, but that's definitely a huge factor for me. And then just knowing how Tesla traded, knowing that it produces like momentum moves, and I'd say like that's one of my strengths. That's where I prefer to get really big. I just find it a lot easier personally. So I was thinking that there could be like some A+ opportunities of the day.
Okay, great. So are you already visualizing the kind of risk that you might put on the trade ahead of time?
I try to do that and try to like calculate kind of a general idea of how many shares I might want, just to make it easier if I have to make any quick decisions.
Okay, great. So in terms of like, you know, obviously we don't know whether this is going to set up. We don't know what the price action is going to be. It could just tank on the open, right, and not present, you know, the type of trade that you made. But in terms of visualizing that risk, when you're thinking of the shares that you're trading, how are you doing that? Like, how are you thinking like, okay, this is how I'm going to get an idea for the X amount of shares or the X amount of dollars that I want to risk on this trade?
Okay. So for me, in one of these slides, I actually go through and I calculate the expectation value. And like the first trade of this series had a very high expectation value. It was over like 3.5 or something, which is huge. Yeah. A lot of it is, I need to wait till I see it. And it's like very clear on the tape because this is a momentum trade. Yeah. It's not like an idea trade. It's not really like a trend day trade. It's like I'm anticipating that there's going to be a moment where I may see the momentum. and I need to have an idea of how much size I want to get in when I see it, and depending on how clear it is. So I remember like the tape in this one was one of the reasons it was like A+, because like me and Cam both watched it together and we're like, right there, it's like 90% chance it's
Okay,
good.
yeah. So there was a real moment in this
Yeah,
trade.
yeah.
Okay, that's great. That's huge because when we trade and we're trying to assess risk,
Mm-hmm.
there's kind of like there's two factors for me, right? One of them is how am I grading this setup? Like,
Yeah.
is it an A+ setup or is it a B+ setup,
Yeah.
right? And there's going to be a big difference in the risk that I'm going to put on between those trades.
Yeah.
The other factor is in terms of the actual execution that I'm putting on,
Yeah.
right? Is this a feeler position? Is this a position where I kind of have an idea that the trade is starting to develop, or is this a real see it moment?
Mm-hmm.
So here it sounds like you already have something that you think can be A+ that's setting up, and then you actually got your real see it moment. Like you saw it on the tape, it was a momentum trade, it was getting tight in terms of the price action. So you're able to kind of marry those things together. Because for me, even if it's an A+ trade, if I'm just going to be putting on a feeler because something's starting to develop and I'm starting to see, maybe the bids come in at a moment and in an area where I think it's kind of reversing and I want to get involved, it might not be a place where I feel like I can put tons of risk on, but I want something. And so even that feeler is going to be way smaller than, what we call like the see it moment. And the see it moment really is when we want to put on the A+ risk, right?
Yeah.
So we'll get into the price action in a
Yeah.
second, but first I just want to talk about kind of how we get from the idea of, okay, we have an A+ setup, right? We have our variables that we've described, right? The RVOL, the price action on the daily chart, the catalyst, the fact that it's Tesla, right? It already has momentum, low expectations, beat expectations, all of these things, right? And you mentioned the tape, which is another factor, right? So when we have all those things aligned, we need some way to contextualize the risk that we're going to put on, right? And the way that we do that is that we set ourselves every single day an intraday loss limit, right? Like you guys have that, I have that, everyone on the desk has that, right?
Yeah.
There's a limit to how much we're able to lose on a day before Carlton, our risk manager, comes over and taps us on the shoulders, right? So if you're trading, if you're at home trading, you might not be trading intraday every day, right? You might be a swing trader, you might be a longer term swing trader, you might be a position trader. So, you could have an intraday stop, you can have a weekly stop, you can have a monthly stop, right? And we kind of have all those things. But if you're a longer term trader, like maybe an intraday stop isn't the thing for you. Maybe it's a weekly stop. Maybe it's a monthly stop. But the key is these are guardrails for us, right? They help us from ourselves, right? When the market's difficult, when we're not really seeing it, we might be fighting the market. Like we don't want to draw down past a certain limit, right? It really helps us put on the brakes. The other thing that this does is it gives us a benchmark in which to risk against. So if we know, let's just say our stop is $1,000 a day. Well, now we have an amount that sort of represents our risk, right? And so we're going to use these things called risk units. And this is the key. Like this is how we're going to be able to scale our trading throughout time as we start to trade bigger, right? So a risk unit for me might be 10% of my stop, right? So when I'm thinking of putting on a trade, I'm thinking in terms of risk units, right? So now a risk unit is $100, right? My intraday stop is 1,000. One risk unit is 100. So I might say to myself, okay, this trade with these variables is worth 3 risk units, right? While this trade with these variables is only worth 1 risk unit. And the reason that we use these risk units and think in terms of risk units instead of dollar amounts is that it helps us mentally and it helps us scale over time. Because what happens now if, we're trading great, we nailed the Tesla trade and all these other trades throughout the month, and then all of a sudden, Carlton gives us a risk bump, and now our intraday stop is $5,000, right? And you at home might not have a risk manager, but you can be your own risk manager, and you can kind of set rules where, okay, like if I do this well over a month, I'll increase my weekly stop limit or my daily stop limit. And that's how we scale our trading. That's how we go from a consistently profitable trader that's trading smaller to a 7-figure, 8-figure trader. The key is to be doing the same exact things at bigger size than we were doing at smaller size. And this can be like a big trick for traders, because mentally sometimes it becomes, even though it's the same trade, even though it's the same percentage of our intraday stop loss, right? The same number of risk units, it's a much bigger dollar amount. So all of a sudden, now that trade that was 3 risk units, it used to be $300, like now that might be $1,500, right? With a $5,000 stop. So all of a sudden we're thinking, oh gosh, now I'm drawing down $1,500. That doesn't feel too good. But the key is that it's still just 3 risk units, right? So mentally we can say, well, you know what? I've lost 3 risk units plenty of times in my career. And today I lost 3 risk units again. And it helps us sort of stay level and kind of understand that, okay, like in terms of the risk rewards and probabilities over time, like this is totally normal, so that we don't have to get anchored to these dollar amounts and get sort of psyched out by seeing bigger numbers on the screen when we start to trade bigger.
I do like how you talked about all the reasons that this was good outside of just the price action, because I find it very easy to like think that I see something, but it's good to have that guardrail of needing it to be like a momentum stock. Like Tesla is, like it has the 20% anticipated like revenue growth per year, which is like the momentum stock definition. And then that history of running. And I think all those things are like the checks that I need to really know that I can play that momentum and like get big in it.
Yeah, absolutely. I mean, for me, that's huge. Like all the contextual stuff is huge, because a lot of the times that's going to be what leads me to even be looking at something in the first place. And then we get to see when the market opens if it's actually going to present itself, which clearly it did here. So what was your trade here in Tesla?
Okay, so this is my actual trade that I made. So you can see that I went long at 240 with 20% my daily stop, risking 2 cents below the low of the 1-minute candle entry. This triggered when we broke above the 23-minute consolidation that formed right below the pre-market high. So I kind of chopped it off, but yeah, the pre-market high was also at that same level. And I could tell that the bids were very sticky near the top of this opening range, as they would not let it drop below 239.50 in the 2 minutes following the initial push through 240. So I remember, there was some size at 240, but we like blew through it really fast. We took it all out and we shot out like maybe like $1 or something above that price. But then we came back and we retested lower. But then we broke out again from that recent high that was formed. And there was a moment right there where like we skipped 20 cents on the tape, but it was like already looking strong before that. And that was like the
skip
key
to
moment.
the upside.
Yeah.
So they just took all the offers and it went.
After, so the first time they took all the offers and it went a bit, which was good. Like, I'm glad it didn't just take them and then stay close.
Yeah.
But that it took them, kind of accelerated, but then came back.
Okay.
But then when it came back, it got going again with like even more momentum.
Okay, great. I
Yeah.
see that pause on the chart, like that little consolidation. Right above the high.
Yeah.
So what I love about this is you're waiting for Tesla to compress and prove itself and hold, right?
Yeah.
Because in terms of risk reward, in terms of controlling risk and being able to calculate risk, it's a lot easier when we have a real level to trade against.
Yeah.
And here you do have a real level to trade against, and it's breaking out of an intraday pattern. So it's just starting a move, right? So that's just it's a great pattern. It's a great spot to be getting long Tesla, instead of, say in the middle of a move or halfway through like a bunch of green candles and stuff like that, it's a lot harder to define risk in those situations. So where were you risking against when you bought that breakout?
So I was risking 2 cents below the low of the 1 minute candle of entry because
Okay.
this was a momentum trade.
Okay, great. Yeah.
Yeah.
Okay. So when that happens, you have your context,
Mm-hmm.
which you really love, and you define that as A+ context.
Mm-hmm.
And now you have kind of a see it moment, right?
Mhm.
With the tape, you've got, what was it, 3.5 RVOL
Mhm.
happening. It's a great intraday pattern. The price action is fairly clean,
Mm-hmm.
and you're really seeing it on the tape.
Yeah.
So would you combine all that and say that this is an A+ setup?
Yeah, absolutely.
Okay. So when it is an A+ setup, an A+ momentum setup for you,
Yeah.
do you have a rule for how many risk units you are going to be risking, or percentage of intraday stop?
Yeah. So it can also depend on like the level of A+ness that it is.
Yeah.
Like in the playbook that I did, in the playbook checkup with Bella, and that one I risked 80% my daily stop. And he was
Okay.
like, maybe that's a little much, but
Big swinger.
yeah. So if it's really A+, I think you owe it to yourself to be in a minimum of 50% your daily stop.
Okay.
Yeah.
So
So here I was too small because I was only in 20% my daily stop.
okay.
But then rewatching that tape, me and Cam did it together. That's the trader I sit next to. We were just like, we should have been so big.
Yeah.
And we like talked about it for like 5 days straight, just like
Yeah.
how we should have
Yeah.
been bigger because it was so pretty. Yeah.
Great. Well, I mean, that's a great review, because like this is the thing, and this is like what I see all the time, and it's like it's happened to me too, right? Is you get a setup like this, everything aligns, and then in the moment, and this is the whole point of this conversation.
Yeah.
In the moment, you end up putting 20% of your stop on,
Yeah.
when previously you had been putting 50% of your stop on a trade like this.
Yeah.
And then this works, and you only make half as much,
Yeah.
or less,
Yeah.
right? Or, even worse, there's a lesser play that sets up, right?
Yeah.
That you think is good, right? But not all the variables are there,
Yeah.
and you're kind of overvaluing it in your mind,
Yeah.
and then you risk 50% of your stop, and then you lose,
Yeah.
right? And of course, now you're going to lose more, and then, you're going to make less on this. And so that's where, like, when we kind of look at our stats at the end of the month and we evaluate what the best trades were and kind
Yeah.
of ask ourselves, like, am I making enough in my best trades?
Yeah.
Am I controlling my risk enough when it's not really there,
Yeah.
when it's B trades? And a lot of the times that can be the difference in terms of, a consistently profitable trader and a trader that's kind of churning, breaking even, or even losing, right?
Yeah.
It might not be that you don't have edge in the trades.
Yeah.
It might not be that you're trading poorly. It just might be that you're not risking enough on your best setups, and you're not controlling risk enough on the setups that aren't really fully developed,
Yeah.
right?
Yeah.
And so I think that if you feel, personally, the way I feel about it
Yeah.
is that if you say to yourself, I want to risk 50% of my stop on an A+ setup, and that's a lot. That's a lot of an intraday stop loss.
Yeah.
Like that's an aggressive trader, but I think that there are definitely trades that warrant that,
Yeah.
for sure. If you have trouble doing that
Mm-hmm.
consistently because it seems like a lot, then it's better to risk 20 or 30%
Mm-hmm.
every single time on an A+ setup,
Mhm.
and just make sure you're risking less
Yeah.
on a B setup. So what an A+ setup risk is to you, right, might be different
Mhm.
to somebody else. The
Yeah.
key here is that it's consistent.
Yeah.
So the key is that we are defining the variables in
Mhm.
our playbooks that warrant A+ risk.
Yeah.
And then we're defining how many risk units A+ risk is. And the risk units are a function of our intraday stop.
Yeah.
So we have to have an intraday stop. We have to know what our risk units are.
Yeah.
And then we have to know what the variables are
Mm-hmm.
that define whether it's an A plus trade or an A or a B plus trade.
Mm-hmm.
And then we also have to know, is this a feeler position
Mm-hmm.
where I'm just starting to get involved? I'm kind of in partial risk right now.
Mhm.
Or is this a see it moment?
Mm-hmm.
So that when it is the see it moment, we're putting on exactly the right amount of risk units
Mm-hmm.
for this level of trade consistently every single time.
Mm-hmm.
And when it's a feeler trade or when it's a B plus trade, we're putting on the appropriate risk units consistently every single time.
Mm-hmm.
And that way it allows our edge to actually come out in our trading.
Mm-hmm.
Because a lot of the times, like I said, like we'll be breaking even just the mere fact that we're not doing this correctly, that we're not
Mhm.
doing it right. So this is a great example because this does sound like you really saw this trade. It was a fantastic trade, and so, you know, it seems like you and Cam both were upset that you only risked 20%, right? Was there anything that was going through your head that like caused you to only risk 20? And I asked this because I make this mistake. I do it all the time, right? This is why we review.
Yeah.
So I'm just wondering, like, do you know, was there a reason behind not risking enough on this?
So as you see here, I was fine to enter 20% where I did, but I should have added another 30% at that key moment.
Okay, so there was an ad. So
There should have been an ad.
So
That's
the
thing.
EV, so to you, the EV, and we define EV as expected value, right?
Yeah.
And this is going to be a combination of what we think the probabilities and the risk rewards are in the play,
Yeah.
right? And it's a little bit conceptual, right? Because we don't know exactly how the play is going to turn out. But in terms of statistics, right, this is
Mhm.
kind of how we have to think as traders, is in terms of risk rewards and probabilities. And in some plays like this that are so fantastic, and Jeff talks about this all the time, and he actually kind of put it in this framework
Mhm.
last week when I was talking to him. I thought it was really smart, is that sometimes on these really great trades, the EV is actually expanding
Yeah.
as the trade is developing.
Yeah.
Whereas if it's a B setup, sometimes the EV is the best only at your first entry, and then as it starts to work in your favor, the EV is actually contracting
Yeah.
because it's moving away from that inflection, and that's kind of where you need to be, like, covering risk, taking profits. But here it moves higher and then holds above that high, you know, with all the context that we laid out,
Yeah.
and this intraday pattern and what you saw on the tape. And now it's holding above the high and it's proving itself. And it's kind of presenting another opportunity to say, okay, like, now if it goes from here, it really shouldn't get back down
Yeah.
to here.
Yeah.
And this is really where it's going to go. So that's an interesting point, because even though you added 20% risk on that first inflection point,
Mm-hmm.
there was another trade, and maybe that was the true see it moment for you
Yeah.
to get up to the risk that you really wanted to get to.
Yeah, so I actually have been working on this more lately after I made this playbook, but sometimes I notice when things break a range, it's important to get in right as they break so that you don't miss it if it goes. But oftentimes it'll like come back, retest a little bit,
Yeah.
and then really get going. And that's why I like to add like about half my risk that I intend to be in for this particular trade in this particular setup as it breaks the range. But then I like to add about the other half after it comes back, retest, and then proves it's going to keep going.
All right, that's a great point. That's an awesome nuance to this, right? Because now you're talking about a very specific trade,
Mm-hmm.
a momentum trade,
Mm-hmm.
and you're outlining a very specific pattern within that trade,
Mhm.
and then exactly how you want to execute that particular pattern.
Mhm.
And it makes sense, right? Because stocks do that all the time.
Yeah.
Like, they like break out and then they like look like they're going to fail,
Yeah.
and they test and they kind of scare people who are trading it too tight,
Yeah.
and then they go, right?
Yeah.
So you want some in case it just goes,
Mm-hmm.
but you might not want the whole thing because you kind of want to be able to navigate that.
Yeah.
And then once it really proves itself, like, it becomes even better. And
Yeah.
so that's a great way to outline like how you're going to deploy risk for this particular pattern,
Yeah.
right? And so you will now consistently know exactly how many risk units you're going to take on the first break,
Mm-hmm.
and now you're going to know exactly how many risk units you're going to take when it really confirms.
Yeah, for sure. Yeah, so I definitely should have gotten bigger there. One thing also is like even higher up in this price action, there were still some very high EV trades that were about like 1.5, 1.7-ish area of EV, which is still pretty good. But that goes to show you that like the first one was definitely the highest EV. It had about 3.5. Okay, so this is something that I think ties in really well to this conversation, because you want to be risking more where there's highest EV. And this is like actually going through and doing the EV calculations based on like the probability I estimate when I see it on the tape, and then just using like what actually happened to calculate like the risk to reward, so that from there I can kind of get an estimate of the EV. And then when I go back and review my results, I can see like, okay, well this had this EV, so was I actually like risking appropriately? And like, are the factors that I'm looking at actually as important as I think they are?
Yeah, that's a great exercise. Like I'll do that with my playbooks. Like I'll kind of reverse engineer the different spots and actually calculate the risk reward on that play. Like in terms of here's what I was risking, here's what I got realistically. And sometimes it's really surprising, right? Like sometimes with some of these plays, they're so good that it's like hard to realize in real time the amazing risk reward that you're getting.
Yeah.
And so if you can get really good at actually recognizing that in real time, like seeing that potential risk reward, right?
Yeah.
Like how tight can I have this stop to make this much, right? Or how far can this go?
Yeah.
What is the potential of this trade? For me to like visualize that and internalize that helps me then put on the appropriate amount of risk units, because then all of a sudden you just feel like you'd be doing a disservice not to. Right? You just you understand the reason why we do this, the reason why we risk more on certain plays.
Yeah.
And that's an exercise that really helps me.
I think it helps me too, because it just gives me that confidence. For example, like the first trade we calculated the EV to be 3.5 or $3.50. So that means every time I play the game with $1, I get that $1 that I played the game with back, and an additional $3.50. That's what's mathematically expected to happen. So why would I not want to do that with like 80% my daily risk?
Right, especially if it has a decent win rate.
Yeah, so
on the play.
Yeah.
And you know, I think that like you're calculating the risk reward, and then you're looking at all that context that we talked about with Tesla. Tesla's just got a huge bid, right? On the daily chart, on the intraday chart, on the tape. It's got a great catalyst, and so now the probability that an intraday pattern like this that breaks out for that to work, it's a very high probability trade.
Yeah.
Right?
So if you see here, like this trade was 4-1 risk to reward, and then the tape was so clear, and the variables and everything. So we said it was like 90% chance at that moment that at least we knew like it wouldn't wick us out. At least it was gonna like go in the money and give us time. At that point, you don't know how far it's gonna go, but we both had like 90% confidence that it wasn't gonna just like wick us out anymore. That it was gonna go from that point.
Well, that's the definition of an A+ trade right there.
Yeah. So. Yeah. So this does, the EV accounts for both the probability, because we had a 90% probability, times the $4 we made, minus the 10 cents, the 10% chance of it not working, times the $1 we were risking in the trade, and then the EV was $3.50 for that first trade that we talked about.
So to tie it all together, there are 3 key elements that help us size our trades properly. So we give ourselves a daily or weekly or monthly stop, depending on our time frame. And these guardrails help us contextualize the risk that we put on for each opportunity. We define our risk units as a function of our daily stop, and as Jen's doing, as a percentage of her stop. We then use these risk units to systematize our sizing based on the level of opportunity. So we have to understand clearly the variables that need to be present for our A+ trades, and we have to understand when a trade or execution might only warrant B+ risk. If we do this properly, when we perform well over time and work to scale up our trading, we can do the same thing using the same exact process with bigger size, risking larger dollar amounts, but it should feel the same exact way. So thanks, Jen. That was really great. Really appreciate it.
Thank you, Garrett. This was awesome. I'm glad I got to do it.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.